This episode was originally a live conversation streamed in November 2021 on the topic of fundraising. For even more detailed information on how to successfully raise funds, check out our fundraising masterclass with Sophie Lamparter and Pascal Koenig, available on our website free of charge. Go to swisspreneur.org/fundraising to find out more.
I don't know if we would have started Dart if it stayed in Switzerland. But I think when you're here and you have all these people around you starting companies and having crazy ideas and moving things, then you're like, oh, maybe we should try that as well.
Welcome to the Swisspreneur Show, a podcast about startup stories and learnings from experienced entrepreneurs. Here's your host, Sylvan.
Good afternoon or good morning to you, Sophie. Thank you so much for joining us today. Welcome.
Thank you. Good to be here.
So today we have a very special episode. Of course, to an investor, we're going to talk about fundraising. Before we do so, I want to quickly introduce you. You are the founder and managing partner at Dart Labs, an accelerator investing in Swiss early stage startups and also helping them scale in the US in San Francisco. And you basically have a lot of experience building the US partnerships, also the bridging the gap between Switzerland and the US. So this is also my first question to you for this live session. What does it actually take to bridge the gap between two fairly different ecosystems on a daily basis? How do you manage that?
I mean, is this a personal question?
I mean, you live there, you know?
Yeah. So I've been dealing with this for quite a bit, right? I moved to the US 2011, so soon it's actually 11 years. And honestly, I was thinking I would come for a year, and even still had a boyfriend and a house back in Zurich. I said, yeah, I'll be back soon, and it never happened. So I think I got quite excited about certain things here in the US, and I think everybody who has traveled here sees a clear difference, I think, at the core of culture and also in a way mindset of the people. I think there's a lot we can criticize about the US, but what I love, especially about the region I'm here in California and San Francisco, is the risk taking, the always looking for opportunity, the optimism that we can make change and that change is a good thing and that the future will be better and that we all can kind of play an active role in it and that things are possible. And that's really something that inspires me quite a bit every day.
Yeah, that's optimism, that positive spirit. It's really contagious to a certain degree.
It is. And I'm honestly we say that. So my co-founder, Ariana, she's back in Zurich, but we both met here. She's also Swiss. And we say this conversation quite a bit. We say I don't know if we would have started Dart if it stayed in Switzerland. But I think when you're here and you have all these people around you starting companies and having crazy ideas and moving things, then you're like, oh, maybe we should try that as well, right? And I think that's, for me, is one of the big difference. The example was also a personal one when I had kind of a decent job before, right? I was working for the Swiss government at Swissnex. I had kind of a career path. Potentially can now become a CEO of one of these Swissnexes. Pretty solid career and pension and all of that, right? A very safe job. And an interesting job too, right? But of course, not your own. So quitting that job and taking the risk of building Dart was something that here in the US, everybody was like, congratulations, Sophie, that's amazing. They didn't even properly ask what it was. Just the fact that you're making that decision and that step was something to celebrate. And in Switzerland, from friends and business partners, everyone was just like, are you sure? How are you going to make money? Is this a good idea? Sounds a little risky, So I think for me, that's the biggest difference.
Yeah, that's really significant. On the other hand, what do you think, if you then take the US perspective on Switzerland, what surprises people from the US when they come to Switzerland or work with Swiss startups, Swiss companies, Swiss people?
I mean, I think they're all super impressed about technologies that we're developing in Switzerland, talent there is, the excellent universities. If you don't deal with technology, I think people think of Switzerland as, mountains and chocolates and kind of like those stereotypes. But then they realize, oh my God, no, they're at the forefront of like AI, robotics, biotech. I mean, all these things are become visible when you look a little bit deeper, right?
Mm-hmm.
And people, of course, who work in tech, they know that more and more. I mean, ETH has now quite an international reputation that even Silicon Valley has understood. Yeah. But there's, of course, still for us a role, I think. I mean, at least that's what a little bit the mission of DART is not just helping the Swiss and European founders to accelerate here, but also help American investors, tech companies, big players to show what's happening in Switzerland and spot the talent early. Yeah.
Putting Switzerland on the map, so to speak, of the startup and the VC world in the US.
Yeah, exactly.
I like that. That's a very important job to be done. So the first question I want to ask you in relation to the fundraising part, the fundraising topic, the first step before you actually want to take on any money, any funding from investor is you do have to reflect whether you're a VC-backable company. That's something that often gets forgotten because everybody around you is raising money. And then you think, oh, they are all raising money. I should also start to raise money. So how do I find out if my company is VC-backable or not?
I mean, I think there are a few things, right? I think if you see an opportunity to bootstrap a company and still be able to go at scale, I think that's also a very good option. I don't think taking investors is always the only way to be successful, right? So that's maybe the first thing. Then the other thing is, how scalable do you think this can be? And also, how scalable do you want this to be, right?
Mm-hmm.
VC money only goes in the most scalable companies, right? The goal of every VC, and that's a really, really simple math for everybody out there to know, is every single investment a VC wants this potentially to be an entire fund returner. So that's how they look at the startup. So if you're dealing with $100 million fund, every investment they do, they potentially want their investment to return 100 million. So you can't even, and they will not have 100% equity, right? So if they have 10%, that has to become a unicorn. Otherwise, it's not going to be worth to even get involved. And so in terms of your own kind of finances, there's a bit of, standard metrics that VCs look at, and it's around like being able to do 5 million in revenue within 5 years and 10 million in 10. Yeah. So really just this, and then exponentially double every year. I think if you go below that, then maybe it's not interesting for VC. If you're much higher, they probably don't believe you. So it's somewhere in there. Yeah.
It's a delicate balance.
Yeah, and I see that a lot, honestly. We do tell startups that come to us a lot, is this ambitious enough? Right? Yeah. Because there is definitely, you were asking about the gap, right? There is definitely a gap how you present your goals in Switzerland as well as in the US is usually one is a little bit more conservative back in Switzerland. And so we actually try to push entrepreneurs not just to like, hey, what do you really think is possible? Isn't there like, don't be too modest, but also don't oversell, right? Like find this like healthy balance of, I know, we call it stretch goals, a goal that is ambitious, but achievable, Yeah.
Nice. And in the beginning, you often also have to make a choice whether you want to go directly for VCs, like the traditional, the VCs with a fund or the bigger firms, or business angels. So which one would you choose and why? What does make sense at what stage?
I mean, I love business angels, right? Business angels can be really good and really important. Many of them are smart money, right? And so should actually a fund be. I think what I wouldn't choose, like, is it angels or fund? The question is more, who can help me add value to this? This can be an individual who has deep knowledge about your sector, your industry, your technology, who can potentially bring a network that's relevant to you. This could be an angel, an individual, or this could be the right fund. So I wouldn't make the difference there. I would rather look what can they add, and I would highly recommend everyone to really choose carefully. Right? I think money in a way is a commodity. If you have a good company and if you have a good product and a good team, you will be able to find money. But finding the right people that are supporting your company in the long term, that are there for you when things are going great, but also when things are difficult, I think that adds most value.
Nice. That's also quite a refreshing perspective. We already got the first statements and questions in. So I want to bring up the first one here from Christoph. I think that's an interesting take also of your experience and your perspective. Did the pandemic change priorities and preferences of VC investors? That could be, of course, in any kind. Like, do you do larger or smaller rounds now? Or do you see sectors like the travel sector being sort of avoided while other sectors supporting video conferencing, for example, being boosted and gaining much more relevance for VC investors? What do you see there in terms of development?
I think one of the biggest changes was how the investments are done, right? It's before it was no question. You had to be there in person. You had to have this VC meeting in person. So we dealt with a lot of startups from Switzerland and Europe coming for a week, trying to put in as many investor meetings, then being away again and trying to come back. And so that is removed. You can do a lot on Zoom now. I mean, we have done a lot of the investments over Zoom, and so do other colleagues of ours. So I think that in terms of the logistics of your fundraise is a huge asset and an advantage now, I think, especially for European founders. So that's that piece. Then I think at the beginning of the pandemic, there was a lot of like, oh, now everybody was pitching like, okay, this is now for remote teams, or this is now a business that is growing through the pandemic. But I think real investors, and I'm trying to count myself to them, was trying to look more long term. Hopefully we get this pandemic eventually under control, right? And we'll be able to travel again. And of course we will be. I would not have invested in a company that I'd see is like a pandemic solution, right? Even that might increase and creates value. But for example, we invested in a virtual event platform, but that also works hybrid, because we do have the hope that there's going to be some sort of normality coming back. Yeah,
of course.
Then I think another thing is, at least that's what I'm noticing, is I think the kind of impact component has become much stronger for a lot of investors around health and around climate change. And I do believe the pandemic has been a big reminder for all of us how vulnerable the ecosystem is. Yeah.
In that regard, you mentioned doing Zoom meetings to meet investors.
Yeah.
Have you ever done a Zoom only or a remote only closing where you actually never met the founders in person at all?
Yes, we have.
So that's not a deal breaker at all then?
No. We have done several. Yeah.
Amazing.
And so my colleagues. Yeah. I mean, it's always nice to be able to meet in person. And as soon as we have the opportunity, we will, because I also think, I still believe that the relationships can become stronger when you have a beer or lunch, right? or yeah. So
absolutely.
if we can, we absolutely do. If it's not possible, it's not a deal breaker at all. Yeah.
Sure. On the other hand, what we also currently see in the financial markets, it's that they get flooded by central bank money. So you have much more money in the markets, and also therefore, as a result, much more money being invested into startups, driving up valuations. As an investor, do you see that in any form that the competition increases or that it's harder to get into the deals? How do you experience that one?
Absolutely. Yes, absolutely.
Okay.
Yeah. Valuations are getting higher. There's more investors competition on the same deals, exactly what you were saying. And I think it's really a macro trend, right? More and more private equity firms who come into earlier stage. Big VC firms have started their seed fund. So it's basically giving it a shift to earlier stage. And we are kind of still safe because we do pre-seed. I don't know, many VCs touch pre-seed yet, but on the seed level, you have now a lot of big VC firms with very, very deep pockets.
I think it was you who actually told me that pre-seed is the new seed round.
Did I say that?
I think so.
Maybe. And then, for me anyway, it's always mind-blowing also the difference still between Switzerland, Europe, and here the US, right? Yeah. Often the valuation can just be doubled by just being in the US and having the right investors here. I just had a really crazy story this week. I talked to a founder, European founder, and they were talking about something like a 6 to 8 million valuation was his goal back in Europe, and he already had term sheets and negotiations, and then he got accepted into Y Combinator.
Yeah.
And then Y Combinator recommends you to basically stop these conversations, and investors came back and was like, okay, what about 15? And he was like, no, we'll talk again in March. And what about 20? Exactly the same That's investor insane. Who wanted to give a $6 million term sheet. And you're like, oh, so embarrassing for our entire industry, I think.
Of course, yeah.
Because the company or the team hasn't changed.
Exactly,
so,
yeah.
Do
you think that this is sustainable? Like, is it just a result of the pandemic, or will it always continue to be like that? Because it's like the good deals are scarce, and therefore the prices just increase to insane levels to a certain degree.
Yeah, there has to be some sort of bubble that's bursting eventually, right? It cannot continue like that, and So I don't know. Our strategy in that sense is really to invest in teams and technology that are here for the long run, right? Mm-hmm. And I think we do a lot of also deep tech and a bit more difficult things to scale. Also sometimes hardware, where a lot of VCs still stay away from it. And there, I think we're in for the long run. Yeah.
Great. So something that you also, the best case scenario is, of course, the investors finding you, but very often you as a startup actually have to go and look for investors. So what are some of the best ways to do that from your experience? What would you recommend startups to do to actually look for investors?
It's really important, I think, to have a good list of investors you want to talk to before you even start the process, because one of the things, and you probably have heard that in all the kind of how to fundraise sessions, but FOMO is a real thing amongst investors, right? The fear of missing out. So you always want to create this momentum. You always want to talk to several investors at the same time. You don't want to talk to only one. Because then this one person can just say, okay, yeah, it's interesting, and drag this on, and come back in a few months, show me your progress, But if you're talking to a few, there could be the fear that you're closing the deal and they're missing out. So It's really important that you talk to many at the same time, and in a kind of that condensed time frame, right? So really create that momentum. So the most important thing is to have a really good list at the beginning. And so what I would do is I would look at other companies that are similar, not direct competitors, but in a similar field, see who their investors are. And that's really easy to find out online, do a bit of Crunchbase research and so forth, and a bit of Googling. So that's one good thing to do. Talking to a lot of other entrepreneurs, finding out who their investors are, what investors they like, do your own research on funds, go through your network. I think it's still very valuable to have a personal introduction to every investor. I mean, it is a reality, right? If a good contact of mine, let's say a startup that we invested in, or an investor of mine, or even a friend of mine comes to me and says, "Hey, I met this team. They're really cool. Could you have a look?" Then you look, right?
Of course you do that. Yeah.
And so that might take some time, and don't be shy to ask people for introductions. I think that's how you build your network, and we all do that. And good investors will also help you. Like they say, like, oh, maybe this is too early stage for us, but I could introduce you to this person. So don't be shy asking that. Also, if you get a no somewhere, right? Like, oh, do you know somebody else? This could be interesting.
Yeah, it's like in a B2B sales process, it's very similar from my perspective. If they don't want to buy, oh, do you know anyone else who might benefit from our solution?
Might buy, yeah.
Exactly.
And I think what a lot of entrepreneurs, they're kind of thinking they need to raise money, right? So they need investors, and they're kind of trying to sell to investors, but I think you're probably more successful if you shift your mindset and you think like you're giving these investors an opportunity. Investors are looking for investments. That's their main thing. And it's hard to find good investments. It's really what their success is dependent on your success, right? So if you're building a company, you're basically giving them a chance to be part of that. Yeah. And I think if you think like that, your fundraising is probably going to be a little easier, because it's not actually you're trying to sell to them. You're actually just offering them a partnership,
Yeah, I love that perspective. It's also what you mentioned before. Like if you build a successful company, if you build a strong traction in terms of you have a lot of users or some nice revenue and some strong growth, then the money will basically follow you because you're building something valuable. Versus you focus too much on getting the investors on board, you completely forget, because you cannot split your time into doing both very, very good at the same time. You do have to make trade-offs in that regard. If you focus too much on the fundraising process, not that it has to be that way, but maybe you're not building the best case possible, the strongest traction possible. And if I had to choose, I would always go for traction. Money will follow, because if you build something people want, you either can bootstrap for longer, or the investors will knock on your door because you have such a cool case that they want to invest in.
Yeah, absolutely. And I think that's probably a really big challenge for every CEO and every team, is like to set these priorities, right? Because fundraising takes time, and you don't want it to be your only job, right? And that's another thing. Like, prepare it well, do it focused. Like, make sure your team knows, okay, the next 2 months for fundraising, right? Because the CEO will have to be absorbed for a while.
Absolutely.
Yeah, and make a good decision when you do that. And then there's also like, you're kind of always fundraising a little bit, right? In the sense, like, you're always building relationships. You always have to think about the next round. So being
after the round is before the round.
Yes. And it's also okay sometimes to tell an investor, hey, like, right now it's not the time to talk. Let's talk again in 6 months, right? Because you need focus. You need to build a company. I think the fundraising should be a side
ideally,
project. Ideally, exactly.
Yeah. This talk is supported by Small PDF, the successful Swiss scale-up making PDF easy for over 1 billion people around the world since 2013. You may remember them from a previous podcast we hosted with their CEO, Dennis Just. Their mission is to make PDFs and life easy for people across the world, a mission made possible with their 90+ amazing employees across Zurich, Belgrade and Barcelona. If you want to join this fast-growing Swiss scale-up, visit smallpdf.com/Swisspreneur and apply. So then once you have that initial contact set up, either through a referral or you reached out cold to investors, usually what you also send them or then even present in a call is your pitch deck, right? Mm-hmm. So what makes a good pitch deck? What gets your attention as an investor? So startuppers can learn how to build the right pitch deck.
I think I mean, that's very personal. I think we're also a team, at Dart, and I think so are most funds. And often I think each one of the partner brings a specific lens on what he or she cares about and what they look for, right? And I'm very people oriented, so I really look for story. I really look for passion in a founder. I really look for a good functioning team. Yeah, and I think that's maybe my biggest advice to especially Swiss founders is they often forget the story and the excitement in their pitch. Like, give me the why are you doing this? Give me the why are you the right team to do this? Make me excited, and then you can give me the market and the metrics and all of that, right? But first, like, why, And I think Americans do that really well, right? They get you excited, and then because imagine if a VC looks at several pitches a day, right? And you need to be able to shift from why should I care about this, right? So give them a hook at the very beginning, right? Yeah.
And there's this question related from Moritz. Are US startups better prepared for pitching to investors than European startups? Is there a difference? And that's what you just mentioned, right? With the storytelling. Why are you doing that? Do you have a good example? Is it like solving your own problem that gets you attached, like a great personal story behind it? Or what is it that hooks you to that startup team, to the company's vision that gets your attention?
Yeah, it's either why this is really going to make a difference and why this is a huge problem you're tackling, right? Like this type of excitement and story, and how you found out about that, and why you know that your solution is really needed, or then very personal, right? We have that too, right? Like something that you experienced or some specific know-how that the founding team has that brought them to that insight or that conclusion. But I think tie it very much, especially in early stage, tie it very much to that team, because basically you're investing in the team and the idea at this early stage, right? And I think most of the conversations we have also among our team and with other investors is often, is that the right team, right?
Yeah.
And for the first 5 years,
Sure.
And then maybe you hire a CEO and maybe there's somebody else who really does the huge scale up. But for the first 5 years, it has to be the founding team, right?
Yeah, there it's crucial because it's easier to replace the idea than the full team, right? If the plan doesn't work out, and there will always be challenges. And if you need to make a pivot, a good team can execute that. But if the team is wrong, even the best idea will probably not work out.
Question from Moritz. I think because when I was working at Swissnex, I wasn't only working with startups. I was also working with professors and corporates and a lot of different types of people. And this whole storytelling component, I could see across any type of industry or discipline. I think Americans are just more trained also in school to just get up and tell their story, and it's just more I think it's just training, so I think the Swiss can definitely bring it up a notch. I think often in a pitch deck the why is missing, and I'm like, well, why should I care? give me the why.
Sure. And here maybe that's also a good related question from Paul. He said, you're invested in Inverse. What is their vision? So what basically attracted you to their vision to invest in that company?
So Inverse at the time, that was very, very early. That was even before we had our own fund. Basically, we did a syndicate to be able to invest in Inverse. So they're an EPFL spinoff. What they're doing is basically hologram technology. So they have built their own engine that is voxel based to be able to have a 3D representation of your body in a virtual space. So what excited me is eventually, now there is a lot of buzz around the metaverse, right? I don't know how much you are gonna want to be there as an avatar. Or do we eventually want to be there as Sophie and Sylvain and Paul and interact with each other that way? So I think hologram technology will eventually feel the most natural to interact. That's why we invested. And yes, of course, they had already had an office here in the US. For them, it was pretty clear that they have to have a presence here in terms of VR and augmented reality and spatial computing and all of that. There's just a lot more companies working on this here, and there's also more money flowing into this here. And I think they're having a moment right now. They're racing around right now, and I think they benefit highly from that whole metaverse buzz. So
yeah, of course, the timing is right.
Yeah, I have a call with them Monday, so I'll get
Perfect.
the update. Yeah.
Cool. Hey, thank you all for these great questions. Keep them coming. I also have a few more for you, Sophie. And basically, one thing that often happens when you're looking for investors, they lead on you. So they say they are initially interested. They find your company, your team fascinating, but then maybe they don't communicate it directly, but they have no intention of following through and actually doing an investment. How do you deal with those investors? Because you don't want to sort of close the door if they eventually might still invest. You don't know. But at the same time, you also can't wait forever. So how do you handle that as a startup founder to not burn any bridges?
I mean, ask them directly. Ask them how likely is it that you're investing in this round? What are your normal ticket sizes? How long does it take you to close? Do you lead? Do you follow? How much have you reserved for follow-ons? Like all these things, I highly recommend to ask an investor. And you can ask that in the first call, like the way they ask you questions around your startup and what your plans are. The same way you should ask them what their plans are, and they will tell you. And they actually don't mind. Like I don't mind if I get these questions, because then I know this founder actually understands what matters, right? So I don't be shy to ask them questions. And if they drag things on, then you just like that's what I said before. This kind of dragging things on. It's like they're not quite sure because they want to wait until like this lead comes in or another investor that they look up to. And as soon as that happens, they're probably in, right?
Yeah.
So many of them, we say sometimes some investors are also just sheep, they like to follow others that are leading. And so many of them are probably in that category. They keep the conversation and let's talk again, because they want to see, are you going to be able to pull this round off? Is there going to be an interesting VC coming in? So keep them warm until you have that lead. And then let them know. So now I know the round. This is my timeline. These are the terms. Are you in? Are you out?
Perfect. It's also a really good question to include in the catalog that you just described. Are you usually leading the round, or do you prefer to follow?
Yeah.
I love these questions to qualify, because it's a two-way street. You are partners eye to eye on the same level. And it's not like the investor is so gratefully giving you something. No, it's a partnership.
Absolutely.
That's
you're
crucial.
giving the investor something, right?
Yeah.
I mean, what an entrepreneur is building has a lot more value. Honestly, that's what I think. Than somebody gathering money somewhere and investing it. Oh, I'm not saying that this is not an important job, right? But but you're the main actor in this, right?
Yeah.
You're building the company, you're building the product, you have an invention, so see it differently. I think the hierarchy, I mean, it should be eye to eye at least, And another thing that I recommend is and follow-on investors aren't bad, right? But it's really good for you to know who are the potential lead investors and who are the potential follow-ons. And then you focus, of course, on the lead to get the terms. And the follow-on investors, you can always ask like, hey, is it okay to communicate that you would follow once I found a lead, right? And they might actually say yes. And then it's like, could you mention a ticket size or a range? Would you consider investing? And they might say, our ticket would be between 300,000 and 500,000. And then you can use that to talk to the lead investor and to the others, say, hey, I've already soft committed this and this. I already have people to fill the round.
Perfect.
These are all good things that other investors love to hear.
Mm-hmm. Yeah, it's all about building that momentum and also the trust to a certain degree. Nobody likes to, go into too much risk and say, I don't know if the others join, but if you can build that momentum, perfect.
It's all about that. It's all about that. And I've been in that process, right? Where nobody's making a decision, everybody's kind of waiting, and one makes the decision, and then everybody wants it. It's just
exactly. Yeah. Then one thing that you often also hear are NDAs. Should you, as a startup, make prospective investors sign an NDA, or is that a red flag, a no-go?
I would not. I mean, avoid as long as you can. Like you wanna keep the barriers really low for them to talk to you, be interested. I mean, I can't imagine what for the first couple of conversations would be there that you cannot share, right? If there is something that's really highly confidential, maybe on the level of the data room where you have like IP paperwork and patents and things like that, then I think you can do it if you see the need. But before that, I would not. And make it easy for investors to like go through your material. That's another thing, right? Because if it gets too complicated, you might just risk to lose their interest. I don't know. I was once, somebody invited us to a data room where there was this like mark over every document, the confidentiality mark, and it was so impossible to read that you're just like, oh. No, I
give up there. Yeah, sure.
I don't want to deal with it. So definitely, try to avoid that. And have your things ready. So like that's maybe another good advice. Also related to the momentum, right? If I have seen the deck, had a first conversation, then I have more questions, right? I'm asking maybe for projections or something, and then we're building them right now. I'll get back to you next week. That's not good, because then I know I'm the only person that has asked, right?
Sure.
And then I think you're not quite ready yet. So better have all your things ready that the investors potentially ask, and have that in your back pocket. So when the question comes in, here it is, boom, 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 and that's like, okay, something is happening. It's going. Sure. Okay.
Thank you for asking, Sophie. We actually got that question a lot. Here's our sheet.
Very good. Perfect. Oh yeah, this asked me yesterday. Here it is. No.
Exactly.
Yeah.
Then, of course, another hot topic. There's no general answer to that, but let's focus on the pre-seed stage. Founders always ask, how much equity should I give up at that stage? I know there's no fixed number or one solution that fits all, but what is your recommendation about thinking of how much equity you should give away?
I mean, honestly, as little as possible, right? Because you are in for the long run, and you will have other financing rounds that you potentially need to do and want to do. So the rule of thumb is try to stay under 20% for each round. It depends a little bit on the stage and frequency of the rounds, right? But usually, I mean, it's also there. It's a little bit of finding the right balance, right? Thinking about what's the potential valuation I can get at this stage I'm in. And then from there, how much money does that allow me to raise in that stage to be able to reach a next, we call those inflection points that would increase my valuation, right? So basically, we're telling people, just because you could raise 5 million right now, maybe that's not the right thing, because your valuation cannot go much higher than 10, and you would give up already 50% of your company. So maybe you'll raise only 1 million, right? And only give up 15% of your company. And with this 1 million, you get to a point where you can show customers, where you can show a finished product or whatever it is. And that will enable you to raise that at a higher valuation for that next round. So, it's kind of raise enough so you don't have to fundraise all the time. Ideally, it lasts you a year, 18 months, right? And have a bit of a buffer, because it's also kind of nice if you go into the next fundraising round and still have at least 6 months of runway. So you're not like, if you start raising and you have the water already here, then you're not in a good position to negotiate. You're not in a good position to make choices. Exactly. So, so raise what you need plus another 6 months, I think, something like that. Yeah.
Cool. And you mentioned
investors,
inflection.
good investors should be able to talk to you about this too, right? Like what are your plans for this round? What is your plan for the next round? What will you need for the next potentially 2 rounds? Like all of that should be part of your deck and also part of a discussion with your investor.
And you mentioned the inflection points. They are so crucial, not only for the fundraising story, but then also for future rounds, because you have to hit them to be able to raise the next round, right? Do you have good examples of such inflection points?
Yeah, it's really anything that gives validation, right? Traction is a good validation, right? It's customers, it's entering a new market, having a product in the next version ready, hitting milestones in terms of your team growth. Cool. Everything that validates that you're doing the right thing and that you're going to be successful, right? Basically that gives every investor comfort that you're going to make it, right? And so my little story before from VC, right? Even though that's crazy, but the fact that VC is an investor is some sort of validation.
Yeah, of course.
Right? Are you, or is that going to quadruple your valuation? Probably not, but it's an indicator that you're going to succeed, and it's almost 100% indicator that you're going to be able to close the next round, right? And that's worth something. So
absolutely,
yeah.
And then you also have to sort of justify the valuation to your potential investors, because you don't want to have it too low to give away too much equity. But you also, of course, have to balance all the future hope, especially at such an early stage like a pre-seed. So how do you justify the valuation of your company? Do you have any good framework or tip on how to do that?
I mean, there is, talk to a few people. I think that's what I come up with something. Come up with something that you think feels right and fair. It's not too high, so you're able to. I mean, that's another thing, right? A very high valuation is not always the best thing, because you need to be able to raise the next round, and ideally you want to double. So if you're at the way too much, a too high valuation, and suddenly it becomes difficult to match that. So being somewhere in a healthy, fair range. So think about it. What do you think makes sense? Look at other companies in your area and what they've gotten, and then go out and test it. I think that's what I would do, is talk to a few investors that maybe don't invest in your field, but or that you're friends with, or that somebody knows, and test it. And see, like, hey, I'm thinking that, does this make sense? And with many of them, you can also discuss, right?
Sure.
But it's a tricky thing, because it's a little bit artificial in a way, right? Yeah. Especially in that early stage where you don't have actually any sales numbers yet or any revenue, right? So it's really how much value has the team, the idea, how big is the opportunity. Yeah. So there is no clear rule, but there are ranges, right? I mean, if it's pre-seed, it depends a little bit if there is like a lot of IP, if you're like a university spin-off, or if it's just a good kind of service product, but it's somewhere between 2 and 5 million in the pre-seed stage, and then in the seed stage, it's somewhere between 5 and 10, right? So
I think that's a good sort of range to aim for. So that gives people a good reference value to a certain degree.
And then list what you think is what you have already validated and why you think you're the right list. It's like, my team has achieved this. We have this experience here. We've already built this IP. We already have this first successful pilot. Yeah. Pilots are really good. Letter of intents are really good. Pilots are great, right? Because that shows an investor that the industry is already ready for this.
Yeah. With us, when we did that,
beta users comment. What
we did the B2B space. So we had contracts that only started running once we actually went live with the product, but we had legally signed and legally binding contracts, and that really built a lot of trust.
Yeah, that's again, it's an early validation, right? It's like, oh, people want this.
Exactly. Now let's assume you successfully closed the round. How soon should you start with the next fundraising round?
I mean, I think you're in your mind, you're always fundraising in the sense of you're always building relationships, right? And so I think good communication to the existing investors is really important. From what I'm seeing, the most successful companies are doing actually a really good job at that. They have, like, let's say, a monthly investor newsletter where they just like, hey, these are our highlights. These are our lines. Oh, we need help on this. And you really use them as a resource. That's why you have them, right? If you just see them as like pure financial investors, then maybe you don't utilize them fully, right? So that's that. Especially if you have investors in there who would potentially invest again or lead the next round, right?
Sure.
And then all the others that that are later stage, right? I don't know, gently, when you see them at an event, tell them about how things are going, give them an update, but try to do it a little bit natural, right? You're not looking for money. And investors actually like talking to startups when they're not looking for money, because it can be a much more conversational meeting around, like, where do you stand? What's going on? What are your pain points? What successes? Yeah. And then I think, I don't know, what would I say? Probably the whole thing takes about half a year, in the sense of, like, internally spend some time to think about your timing, make a bit of a fundraising roadmap. All these conversations around valuation, make the investor list, and then going out, talking to people, pitching 2-3 weeks, and then another month to kind of figure out who is the lead, closing the term sheet.
Right.
So you're probably quickly at 6 months, unfortunately, the entire thing.
That's a reality. Yeah.
But hopefully a lot of it in preparation. So once you go out and really pitch, you can do it in a month or two. Yeah.
Nice.
Yeah.
We also have sort of a follow-up. It's not a real question, but more of a statement. So I wonder if you agree with that from Stefan. He says the value of a company also depends on the common view, because it's not yet traded on the stock exchange. It's not public yet. And therefore, it's almost irrelevant. And most important is that an investor sees the potential of the product. So basically, I think what he's saying is your company is worth what someone else is willing to pay for, to a certain degree.
Absolutely. And that's exactly what I meant before, right? Let's say Sequoia invests in you and you get this $10 million valuation. Then everybody else is like, yeah, sure, here, right? It's just like,
right? But this is so mind-blowing for me, because then this almost becomes to a self-fulfilling prophecy to a certain degree. So these big VC firms, these big brands, they have so much power. Even if that should not be the case, if someone else would not give that company that valuation, if they do it, others will follow, because, oh yeah, you did it. You have your brand, so I believe you. And then it is 10 millions of value.
Yeah.
That's crazy.
That's reality.
Yeah.
But that's exactly what he's saying. Like, that's the view of somebody. What's the value of the opportunity here, right? The potential of a product. Yes. And if somebody is willing to pay that, and this person is somebody that others look up to, then then you will find others who pay that, right? And
Absolutely.
then that's the price. But yes, of course, certain VCs can definitely control the ecosystem and make people win and others lose. Yes.
That's the game.
Yes. But there are many ways to success, right? And there are
Sure.
also a lot of different investors in VCs. And also what I think is actually quite exciting is there's a lot more different forms of financing also opening up, right? Like, there's crowd investing, but there is also, for example, revenue share VCs that are coming up more and more. Right. For certain businesses, this can be really make a lot of sense because you need the money now, but as soon as you make a lot of revenue, you pay back, and they're not going to stay a big stakeholder. So I think there is a lot more happening, and I think will be beneficial for entrepreneurs that they really can choose, like, what type of company am I, or I want I to be, and then look for that type of investor that fits your mission and plan, right?
Yeah, I would say it's a really exciting time to be an entrepreneur these days.
Yeah, absolutely. Absolutely. I mean, there's so much happening. And also just in Switzerland, I mean, there's so many new funds now.
Yeah.
And that's definitely like, there's a lot more competition in those early rounds that were unseen before.
That's great for founders because now you have an option you can choose.
It's great. It's amazing. I mean, your goal always has to be to have 2 or 3 term sheets, not just one.
Exactly.
Right? Mm-hmm.
Hey, Sophie, I think we could talk for hours, but I want to wrap up
already. Okay.
Almost. Yeah. I just want to be respectful with your time. And I want to wrap up today's episode with some rapid fire questions. So I give you a short choice, a few options to choose from, and you have to make a statement and a choice in one sentence. Are you ready?
Yeah. So okay. Yeah. I don't know what you mean, but yes.
You will see. So the first question for you is being a founder or an investor?
Me, myself?
Yeah.
It's an interesting one because it really is both. I see myself also as a founder because we've kind of bootstrapped Dart and then we started fundraising ourselves, right? And it's not like I joined a big existing fund. We're also fundraising. We also had a long conversations several months about how much runway do we have? Can we pay salary this month? So at the beginning of Dart, we are very much a startup,
Let's say the founding investor, right?
Yeah. And they call that the emerging fund managers, we're called.
Exactly.
So, yeah.
Next one, if you had to choose between bootstrapping or VC money?
I mean, if I can bootstrap it successfully, I bootstrap it. Yeah.
Yeah. Nice.
But then, it all depends. It's like, do you need scale and speed? And if you need speed, because then it might make sense to take some money.
Yeah. The next one for you, early and small exit or big and late exit?
That also is really like for us as an investment thesis, we're trying to do both, right? We like to have a few exits, and I think most VCs are actually looking for just IPOs and unicorns, right? I said those fund returners. Our model, because we're rather small, we can actually afford to also have some earlier exits that are quite nice for us, that bring new money into the fund. And we just had an exit earlier this summer from the portfolio, and that was before their seed round, actually. And for us, it was quite nice because that's new money that came in that is now already invested again. So perfect. I wouldn't choose. I'd love both.
Both.
Actually.
Yeah. And if you had to make a choice between going IPO or doing a trade sale?
I mean, it's always great, I think, to really have big ambition and think that you can run this company until IPO, right? But we also see now the trend that big companies don't even IPO anymore, right? Those Stripes and family, right? They're like, why do I even bother with all the regulations you have as a public traded company? And then we've seen SPACs, and they're also there. I think is quite some innovation happening. I'm also actually quite excited about digital shares and tokenizations of companies. I think there will be another wave coming.
I certainly have an impression that you will probably be back here on a live Q&A session very soon, Sophie.
Oh, really?
Yeah,
On that
there are so
topic?
many more topics that we can talk about. But for today, the very last question, I'm curious to hear what you say. San Francisco or Zurich?
You're asking me all these questions where the answer is like both. Like my no, seriously, like my dream is eventually to have two homes.
Cool. And how would you split your time then? 50-50 or in a different way?
I mean, summer in Europe, winter in California.
Yeah, I thought so.
Easy.
Cool.
Yeah.
Sophie, thank you so much. That was a lot of fun and the time was flying. I mean, 1 hour just passed away in like no time. Thank you so much for joining us. Have a wonderful Black Friday weekend. And we're super excited to see you back here, hopefully very soon.
Yeah, I hope so too. Thank you so much. And have a good day, everyone. Oh, happy weekend. Yeah, it's Friday night.
Yeah, exactly. Yes.
Yeah. Good.
Take care, everyone. Thank you for joining.
We hope you enjoyed today's episode. If you did, you can support us by rating our show on Apple Podcasts. This way, we can reach an ever-growing number of aspiring entrepreneurs.